Last week, gold didn't just move higher, it lunged toward $5,000 an ounce. Copper climbed quietly, pressing against its all-time highs. But silver? Silver crossed a line the market had talked about for years and never quite believed would actually happen. Over $100 an ounce. For the first time, ever. And the moment that number printed, the conversation changed. Not, is this real, but what does this break next? Because moves like this don't happen in isolation. They happen when something underneath the system starts to shift, when pressure that's been building quietly finally forces its way to the surface. If you zoom out for a moment, what you're watching is not a random rally or a speculative frenzy. It's a debasement trade accelerating faster than expected. Gold knocking on the door of $5,000 wasn't supposed to happen until much later in the year. Silver at $100 wasn't supposed to arrive this cleanly, this early, or this decisively. And yet here we are, barely into January, and the timeline has already broken. Even mainstream outlets are struggling to explain it without admitting what's really happening. Gold futures sitting within striking distance of $5,000. Silver touching $100. This wasn't the forecast. This wasn't the consensus. And that's exactly why it matters. Because beneath the price action, something deeper is unfolding. Funds in Northern Europe are openly reassessing their exposure to US assets. A major Danish pension fund has announced plans to sell US treasuries. India now holds the lowest level of treasuries it's had in 5 years. Private investors at Goldman aren't talking about exiting in 2026. They're talking about staying positioned. That's not excitement, that's repositioning. And when repositioning happens at this scale, price moves stop being polite. Layer currency stress on top of that, and the picture sharpens even more. The dollar index is breaking down, trading at levels not seen since October. It's hovering within 0.5% of record lows against the Swiss franc. Historically, this is the kind of setup that fuels sustained moves in precious metals and commodities, not because of hype, but because capital is looking for something that doesn't dilute overnight. A weaker dollar doesn't just help gold and silver, it exposes how fragile confidence really is. But charts alone don't tell the full story. This market is unfolding inside a geopolitical pressure cooker. Trade disputes, export restrictions, and strategic resources being used as leverage are no longer theoretical risks. They're active policy tools. And that reality is forcing people to ask a question they avoided for years. Is it too late to get positioned in precious metals? This isn't a trade, it's a structural shift, a repricing of money, scarcity, and trust as the world transitions toward a new monetary framework. Most people still don't have meaningful exposure, not because they're late, but because they're still anchored to assumptions that no longer hold. And silver sits at the center of that transition. Silver isn't just a monetary metal, it's also industrial. It's financial and physical. It lives in two worlds that don't behave the same way. That's why it's volatile, and that's why it becomes explosive when those worlds collide. Zoom out again, because silver isn't moving alone. Copper is flashing warnings that are impossible to ignore. We consume roughly 30 million tons of copper every year. Only a small portion is recycled, and to maintain just 3% global GDP growth without electrification, without AI data centers, without renewables, we would need to mine as much copper in the next 18 years as humanity mined in the last 10,000. That's not a projection, that's a constraint. Now layer in electrification, AI, grid upgrades, electric vehicles, and energy infrastructure, and the gap widens further. This is why copper keeps pressing higher even when sentiment wobbles. It's not being driven by speculation, it's being driven by necessity. The physical limits of supply meeting financial systems that assume infinite flexibility. And then there's China. Silver in China is already trading above $115 an ounce. Week after week, bids keep climbing. At the same time, China is tightening exports, not just in silver, but across a range of strategic materials, rare earth elements, lithium processing, copper refining. This is where the narrative shifts from price to power. China controls roughly 60 to 70% of global lithium processing. It imports about 60% of global copper ore, refines close to half of the world's copper, and consumes nearly 58% of it. That level of concentration matters, because when flows tighten, the effects don't stay contained. They ripple outward quickly and unevenly. Markets are very good at ignoring these realities until they can't anymore. And when they can't, repricing happens fast. This is why focusing only on gold and silver prices misses the bigger picture. The entire commodity complex is being forced to revalue itself in a world where supply chains are no longer guaranteed and financial promises are being tested. And silver, once again, becomes the stress test. For the first time in 14 years, it takes just 50 ounces of silver to buy 1 ounce of gold. Historically, ratios like this don't move quietly. They signal transitions, moments when the market is reassessing relative scarcity and utility. Look at the silver chart. The highs from 2011 no longer look like resistance. They look like unfinished business. When you step back, it becomes harder to argue this is a bubble, and easier to see it as a correction that took more than a decade to arrive. So where does this go from here? That's the wrong question. The better question is whether this move has finished repricing leverage, or whether it's only beginning to reprice reality. Because when gold, silver, copper, uranium and lithium all move together, while currencies weaken and exports tighten, the system is sending a message. And it's not subtle. It's telling you that assumptions built on stability, abundance and trust are being re-examined in real time. That doesn't mean prices only move in one direction. Volatility is part of the process. Pullbacks will happen, shakeouts will happen, but volatility doesn't invalidate the trend. It reveals where the pressure is. And right now, the pressure is everywhere. The era of ignoring metals, of treating them as relics or side bets, is ending. Not because of hype, not because of fear, but because the world is running headfirst into constraints it spent decades pretending didn't matter. That's the context this move lives in. So drop your thoughts below. Do you see continuation or a violent pullback first? Either way, the conversation has changed. I'll see you in the next one.